Hello and welcome to today's Fat Tell Daily. I am joined by our small cap guy, Callum Newman. Welcome, Callum.
Thank you, Woody.
Now, today you are focusing on the oil markets, and we've seen, well, it's been down since the start of the year, but we've recently seen a bit of a spike up, around 10%, I believe. Now, you hearken this back to the news back in February 2022 when the Ukraine was attacked by Russia for the first time. It sent the oil markets in a bit of a tizzy. You think that the threat of war, a new war in the Middle East, could potentially be having the same effect on oil prices today? Would you like to just elaborate and give our viewers a bit of a picture about what you're writing about, and then we can go into a few of the questions around your article today?
Yeah, absolutely. So oil prices are up about 10% in the last week or so, and that's all related to what's happening between Israel and Iran and Lebanon. So the crude price is beginning to rumble, and I guess the question that the market is grappling with at the moment is the oil market at risk of a price spike. Now, you alluded to the what happened after Russia invaded Ukraine. So oil and coal also went on massive runs, and so there were very big share price movements in those related stocks at the time. So traders, if this oil rally is sustained, are going to start positioning in oil stocks. However, I've followed oil for a long time and have various contacts around the place, and it's intriguing to see what they're telling me relative to what the mainstream perception is.
Now, you actually mentioned a distinction between the physical market for oil and the futures market for oil. Can you explain for people what that distinction is, very simply?
Well, the easiest way of thinking about it is the physical market is driven by the refining industry around the world. So they're the ones that actually take the oil and actually do something with it and process it into gasoline and jet fuel and all that type of thing. That's the real world of oil and infrastructure and actually servicing what you put in your car and that type of thing. The futures market is different because it's driven by, or partly driven by, positioning of traders. It's, a lot of them are never going to take delivery of, 100,000 barrels of oil. They don't want to go anywhere near it. They wouldn't know what to do with it.
Not.
But they speculate, of course, on the price. So when we get the potential for a disruption like we're seeing in the Middle East, of course, fund managers and traders start to shift their positioning. Now, previous to this, the positioning in oil from the investment community was to be very short. They were thinking that the price was going to continue to go down for various reasons. Now that the Middle East situation looks like it's escalating, they're starting to reverse some of that. So the question that we have to ask ourselves, is this likely to keep going, and is it going to go so far as to threaten the recent recovery around the inflation narrative and interest rates coming down and peaking? If oil was to spike to a very high degree, obviously that would imperil the recovery that's going on in the share market from 2022 when we saw energy prices go crazy. So it is the most urgent issue in the market right now.
You mentioned Karoon Energy, your Karoon Energy trade earlier in the year. Can you talk people through what that trade was and what made you think about it, and what lessons, bearing in mind the dynamics that you just spoken about, what lessons do you think that trade could tell people about how they should trade commodities, or specifically oil, during geopolitical tensions like this?
This is why I brought it up. It's highly relevant. So around March, April, the crude price was doing something similar. It was threatening to break towards $100 and over $100. Now, Karoon is an oil producer. So the higher oil goes, the more they can sell, the more money they come in. The price was beginning to trend up alongside oil. So I saw an opportunity based off what was going on in the oil futures market, that had oil continued to press up, traders would have bought more and more contracts to keep, and they would have becomes a self-fulfilling cycle in a way. They would have kept pushing up the crude price, which, all things being equal, would have taken Karoon Energy up as a trade. But what happened in that particular instance, and what you're at risk if you do something similar today, is that the current rally in oil price reverses, and the speculators start dumping their positions, and then of course an oil related stock will go down. Now, I got out very quickly because it was speculation basically, and the point I make today in the article is to say that all the signals from the physical market is that they are not worried about getting access to oil. The rally in the share price is traders positioning around the Middle East on the assumption that it could escalate, or they will profit if it escalates. So that dynamic of this potentially reversing very quickly is in play. So in other words, don't trust the rally.
Gotcha. You do discuss the potential impact of strategic reserves on oil prices. How do you see the role of these reserves evolving in the global oil markets, and what that might mean for long-term oil price trends?
Well, I know from history that previous big oil spikes were driven by the industry panicking that they were going to lose access to the barrels, and for whatever reason, the US was always very reluctant to tap into its reserves. But after Russia invaded Ukraine, they did release, and that moderated the stress in the system. And I make the point in today's article to say that if the conflict, if it was to escalate, would hit Iranian barrels, all those barrels pretty much go to China. China also has a very large strategic reserve. So it lends me to think that even though we might get a short-term spike, if it was to happen, and there's no guarantee it would happen, that they would both coordinate to push it back down, because neither of them want high oil prices. China's trying to get a consumer-driven recovery, so they'll do everything they can to keep energy prices down. And of course, we've got an election year, so I doubt the president or the potential president is going to sit by and let American voters get taken to the cleaners by speculation in oil prices.
Just final question, considering the current tension geopolitical situation going on, how would you advise investors balance the potential for short-term gains in oil and oil-related stocks to the longer-term uncertainties in the sector?
Well, it depends what type of investor you are. As I say, if you're trading, there could be a move. We don't know what's going to happen. So if oil continues to go up, the oil shares will go up. Having said that, I'm not overly, well, as I've alluded to, the physical market is not signaling a very strong oil price. And previous to this escalation in the Middle East, the oil price was down over the last 6 months, and it was looking very weak. So I just think there's more exciting opportunities on the ASX than the oil sector right now.
And final question: obviously you're our small cap guy, and you published the flagship small cap letter with lots of different opportunities in different sectors in, but you also have a more niche trading system approach, which is partly driven by momentum found by the use of AI. I was just wondering, is that throwing up any oil-related signals at the moment? And I know that you work in tandem with that system to put your human judgment on it. But I was just wondering if that's actually throwing up any short-term signals, just out of interest.
Not at the moment. The recent spike in oil is too short-term. We're looking a little bit more intermediate trends over. We need to see at least 1 to 2 months of a definite trend rising before we get to taking a trade in that particular service, remembering that the oil price has really only rallied in the last week or so. So it's a little bit too soon for that particular system to start picking up. If you're very short-term or day trading type of thing, you could be looking at oil, but we need to see a more sustainable rally or a longer rally before our system will kick in.
Cool. All right, Callum, thanks for that, mate. We'll end there. If you enjoyed this conversation, do go and check out Callum's original article published today in FatTail Daily. The link in the description is below. There's also a link to a sign-up box if you would like to receive our daily insights ongoing, completely free of charge, as always. Callum Newman, thanks for your time.
Thank you.